Now we're going to look at what's happening in Europe. And here you're looking at the Eurozone aggregate. Consumer confidence continues to be a problem. Slightly better than expected, negative 15.1. But then look at the PMI. So Eurozone manufacturing expected at 43.5, horrendous, came in at 42.7. So that is not a good situation when you're looking at a country, countries that rely on exports, rely on the manufacturing front. Services expected at 51.6, came in at 51.1. So again, that movement to the downside. So then the composite expected at 49.6, came in at 48.9. Now, we do think the manufacturing bounces. 42.7 is the low point. We will see that bounce, but the services is going to come down further. So that's why we do see the composite actually getting a bit worse, and again, signaling more of that recessionary pressure. The M3 money supply continued to accelerate at 0.6, but again, down from estimates of 0.9. And then no surprise, the ECB raised rates a quarter point. Again, that's something where we don't see that stopping, because remember, the UK was first, the US was after, the ECB was really the last, and we do see that additional pop coming, and because there's still inflationary pressures that are not going away. Germany, PPI was expected at negative 0.4, came in at negative 0.3, but year on year, it accelerated again. And again, when you look at imports, when you look at power, energy costs, they've gone back up. Manufacturing PMI expected at 41, came in at 38.8, obviously a massive drop again. Services expected at 53.1, came in at 52, and then the composite expected at 49.8, came in at 48.3. Now, manufacturing will bounce. That's a really bad number, but we do see some bright spot. But services is decelerating. So even as you probably get manufacturing close to 42, we do see services coming down into that 51. Not quite contraction, but again, moving in that direction, which is going to pull that composite further into contraction, and why we see some of that recessionary pressure and the recession already here. Business climate expected at 88, came in at 87.3. Current assessment expected at 93, came in at 91.3. And then the consumer confidence expected at negative 24.8, came in at negative 24.4. So again, you saw that move down, that additional pressure point. France, fairly in line on business confidence, in manufacturing confidence, production outlook, still negative, owned company production outlook negative, retail sales negative 2%. Then when we turn to manufacturing, expected at 46, came in at 44.5. Services expected at 48.5, came in at 47.4. Composite 46.6. Again, that's well into a recession. That's contraction. We do think manufacturing pivots a bit and actually has a bit of a bounce, but services is not. We don't see a recovery in services. We see that actually getting slightly worse, which is why we see again more of that pressure, because Germany and France are the largest economies in the EU. And you're in contraction. It's going to be difficult to right that ship, given that ECB rates are still going up, consumers are already slowing, inflationary pressures are starting to pivot back up. It's going to be difficult to see that adjust. Difference between the U.S. and Eurozone is that the U.S. manufacturing PMI has stabilized, while it continues to fall sharply for the Eurozone, which we do see stabilizing. Service PMI has been more resilient in both places, but again, that's now showing more weakness in the Eurozone as well. And that's that kind of meat in the middle that we've talked about, which is going to pull down, the GDP expectations and the growth in both locations. Then when we pivot to the monetary tightening in the Eurozone is as strong as in the U.S., the central bank, there's really no major surprise. ECB and Fed will continue to hike in tandem. Monetary stance in the Eurozone is now just as tight as the U.S., but one can hardly see an overheated economy in the Eurozone at this point. But demand destruction, in addition to that, caused by falling real incomes, is likely to prove a bit more excessive in Europe, because Europe didn't recover the same way the U.S. did after the great financial crisis. So that's just a long way of saying the ECB doesn't have to get as tight, but they still have to keep going, because they're still over 1% off from where we are, and there's still some of that upside. But again, you're not going to get to the same level, but they're still going to have to stay there for longer. Eurozone loans to business continues to contract. Households continues to contract, but it's not negative. And that's where, again, you still have a lot of excess in there, and they need to pull that excess out. This is obviously in June. We've seen more contraction into July, but there's still opportunity to, again, raise rates, bring some of this down in general. So then Eurozone composite PMI, just giving you an idea of moving back into that negative. New orders, leading indicator, again, 45.9. And this is for the composite. So this is looking at new orders for services and manufacturing. And that's why we see services and manufacturing, again, still staying in that contractionary standpoint based on those leading indicators. German climate index, again, moving further down. Expectations getting worse once again, which is something that we see continuing. Europe, German home prices moving down. ECB lending, bank lending survey, NFCs and households. Loan demand just isn't there. So lending standards have moved up. But when you look at German home prices for existing homes fell 13.1% in June, the largest decline since October of 2004, down from 11.7 year on year. It's just there's no demand for loans because most areas in terms of the consumer businesses are already so levered, they don't have the ability to continue to borrow. And as the standards stay up, it's going to be a bigger issue. Now, in the US, we have 30-year fixed interest rates. That doesn't exist to the same degree in really anywhere else in the world. A lot of them are 10-year ARMs or adjustable rate mortgages. So a lot of people are seeing a huge hit to their monthly payment, and that's weighing on not only the consumer, but also where those prices are, more so than they are in the US. Now, looking at the climate IFO for Germany, you can see that expectations have gotten hit in manufacturing, in trade, in construction. Started as flatline in services, but again, still moving negative, which is something that's consistent with what we've seen. Italian retail investor is the new marginal buyer for Italian public debt, which is not a good thing when you think about expectations, as the Bank of Italy was the biggest buyer. Italian banks have shied away. So Italian retail investors are going to, again, if I was them, I would not be buying at the moment. But more importantly, when you look at average annual wages, you can see the U.S. has continued to go up in terms of annual wages. This is not adjusted. This is adjusted for inflation. But look at Germany. Germany has not gone up to the same degree. The U.K., when you look versus 2019, Germany, the UK, France, Italy, Spain, Greece have all lost purchasing power, which is why we've been saying that their impact or their pain is going to be more so than what is happening in the US. Taking that, the gross domestic product current prices, Eurozone versus US, Eurozone did not get to that level when you look at that GDP side. So again, there's just less, there's not as many good things happening there, which is why we think the recession strikes here first before it falls into other areas. EU value of sold industrial production, 26 by country, 26% in Germany, 19% in Italy, 11% in France, 8% in Spain. Why we talk so much about these countries, they are the largest in terms of the value there. Disinflation momentum has broadened in the euro area, but we're actually starting to see that flatline and turn a bit back up, which again is putting some of that pressure into some of the momentum that we've seen. Germany is most exposed to trade with China, and as China continues to slow, it's why we've been saying that Germany, that's the ramification, that knock-on effect is going to be bigger into Germany than into other places because they are big buyers of German products. Service PMI, looking at just at Germany, kind of carrying that forward. Business expectations now in contraction on the service front, which again, leading indicator, which is why we think the services pulls down further. Manufacturing, new orders, new low. Obviously 2020 was its own thing, but new orders coming down again, which again comes back to China. They rely on China significantly, and they're not ordering. You're seeing their imports slow, their activity slow, and another reason we see that moving to the downside. And putting that all together, again, why we see a bit of a meet in the middle, a bit of a bounce in manufacturing, but again, coming back down into this piece as we see the pressure point. German manufacturing shrinks in July as demand weakens, and why even as we get a bit of a bounce in manufacturing, services is going to come down. That's going to play out throughout Europe, because even though Germany is the most exposed, other EU nations are also exposed. And then that's where we continue to see, again, those pressure points, those problems. And again, we don't see that staying in general. And that's where we see, again, these underlying problems, the underlying issues, and why we think that Europe is already in recession and it's only going to get a bit worse as we progress through the year. That's what we have for you on Europe. In the next segment, we're going to go deeper into China, Asia in general, especially based on some of the commentary on stimulus that we've seen to date.